Welcome back. While 2025 was a year of adjustment, growing at 2.6%, we avoided the disruption of a recession. Now we enter 2026, the year of stabilization. This isn't a return to the past. 2026 marks the global economy's transition to a new equilibrium. It is a world defined by slower growth, higher structural interest rates, and permanently fragmented trade. So, what does this new equilibrium actually mean for your portfolio? Today, we break down the critical shifts for investors, businesses, and policymakers in this stabilized landscape. Let's dive in. Before we look ahead, let's connect the dots from 2025. 3 critical lessons emerged that now frame everything about 2026. First, resilience without rebound. The global economy withstood 18 months of significant monetary restriction. Growth slowed to 2.6%, but we avoided recession. The thesis of deceleration without disruption proved accurate. Second, structural shifts now dominant. Trade fragmentation and China's evolving growth model now shape economic outcomes as powerfully as central bank policy decisions. The old playbook, where monetary policy alone drove cycles, no longer applies. And third, the long road back. Returning to the pre-pandemic growth trend of 3.6% is a multi-year journey. 2026 is about finding a stable footing, not achieving full recovery. A lower growth baseline has become the new normal. These lessons set the stage for what comes next. So, what does 2026 look like? In a word, stabilization. Global growth is projected to improve modestly from 2.6% in 2025 to between 2.9 and 3.1% in 2026. This represents progress, but we're still running 0.5 to 0.7 of a percentage point below the pre-pandemic trend. The key tailwind is continued disinflation. Global inflation should ease from around 4% at the end of 2025 to between 3.2 and 3.7% in 2026. This restores limited policy flexibility for central banks and allows a gradual shift from restriction toward neutrality. But significant headwinds persist. Trade fragmentation continues reshaping investment decisions. Geopolitical risk premiums are embedded in asset prices. Productivity growth remains structurally lower, and fiscal constraints limit policy space across advanced economies. The theme for 2026 is normalization, not strength. As this chart shows, we're entering a stabilization zone, but still well below the growth trajectory we enjoyed before the pandemic. The first half of 2026 revolves around one critical question: has inflation truly been conquered? By Q1, the answer becomes clear. U.S. core PCE approaches 2.5%, EU headline inflation settles near 2.2%, and even stubborn services inflation begins moderating. This allows central bank language to shift from higher for longer to, quote, data-dependent normalization. Then, in Q2, the policy pivot begins. The Fed likely initiates its easing cycle, probably in May or June, with a 25 basis point insurance cut. The ECB may move slightly earlier given weaker European growth conditions. But here's what's critical. This is calibrated normalization, not panic easing. Real interest rates remain positive throughout 2026. As this chart shows, both the Fed and ECB begin stepping down rates in Q2, with the Fed cutting by 25 basis points and the ECB following suit. Meanwhile, economic momentum holds up better than feared. The U.S. stabilizes around 1.7 to 2% growth, China maintains 4.4% on export strength, and Europe achieves a fragile 1.0 to 1.1% recovery. By the second half of 2026, regional divergence becomes more pronounced.
The United States benefits from earlier monetary easing and resilient services, pushing growth toward 2%. Europe, despite ECB rate cuts, struggles with structural competitiveness challenges. Growth remains barely positive. And China's two-track economy becomes even more apparent. Tech-heavy coastal regions thrive, while interior provinces face significant adjustment pain. The year closes with global growth settling around 3%, an improvement from 2025's 2.6%, but clearly establishing a, quote, new normal, well below pre-pandemic levels. Inflation approaches central bank targets in most major economies, allowing policymakers to finally declare some progress. This chart illustrates the divergence vividly. In the second half of 2026, India leads at over 6% growth. ASEAN economies average 4.5%. The US manages 2%. China comes in around 3.8 to 4% annualized in H2. But Europe languishes at barely 1%, stuck in what we're calling a stagnation trap. Central banks face the delicate task of normalizing policy without triggering recession. Here's how we expect the major players to navigate 2026. The Fed likely delivers its first cut in Q2 at the May or June FOMC meeting. The pace, 25 basis points per quarter, totaling 75 to 100 basis points of easing through year-end. This brings the policy rate to 4.5 to 4.75% by December. The message, calibrated normalization, not emergency easing. The ECB may move slightly earlier and more aggressively given weaker growth, 4 to 5 cuts totaling 100 to 125 basis points, ending the year near 2%. The challenge, balancing weak growth against fragmented policy transmission across member states. The PBOC takes a different approach, targeted easing through RRR cuts and sector-specific liquidity. No broad interest rate cuts. The property sector is still being intentionally deleveraged. The focus supporting high-tech manufacturing and exports, not stimulating consumption. The outlier is the BOJ. If inflation stays above 2%, the BOJ may actually tighten further, potentially strengthening the yen and creating ripple effects across Asian markets. This chart shows how these divergent paths play out across 2026. The United States enters a mature late cycle phase in 2026. Growth of 1.5 to 2.1%, inflation cooling to 2.0 to 2.5%, unemployment drifting from 4% toward 4.3 to 4.5%, and policy rates ending the year at 4.5 to 4.75%. The story is neither boom nor bust. It's, quote, muddle through. Consumer spending moderates as pandemic-era excess savings are fully exhausted, and credit conditions remain relatively tight despite Fed easing. The labor market softens gradually. No sharp contraction, but cooling is real. Services sectors prove resilient, while manufacturing remains challenged by trade uncertainty and elevated financing costs. Corporate profit margins compress as wage growth continues outpacing productivity gains, but importantly, no widespread earnings recession materializes. This chart shows consumption remaining the primary driver of U.S. growth in both 2025 and 2026, though its contribution moderates slightly. The key dynamic to watch, whether productivity gains from AI investment begin materializing meaningfully. China's economy in 2026 is best understood as two distinct tracks, diverging even further. Headline growth 4.3 to 4.4%, inflation just 0.8 to 1.2%, reflecting persistent demand weakness. Track 1, the strong track, high-tech manufacturing is booming. Green energy exports, EVs, semiconductors, and advanced machinery are driving growth in coastal provinces like Shenzhen, Shanghai, and Suzhou. This is where Beijing's industrial policy focus is delivering tangible results. These export-oriented tech hubs are genuinely thriving. Track 2, the weak track, domestic consumption remains subdued. Household confidence stays low amid ongoing property sector adjustment. Interior provinces dependent on construction and traditional manufacturing are struggling. Youth unemployment remains elevated, and near-zero consumer inflation reflects weak demand, not supply abundance. This map illustrates the geographic reality. The teal and dark green regions along the coast, where high-tech exports cluster, are prosperous. The amber and red interior regions, where traditional industries dominate, are facing significant challenges. Beijing's policy response: continue choosing industrial upgrading over broad consumer stimulus. The central question: how long can this dual-track model persist before social pressure forces broader support for domestic consumption? China's economy in 2026 is best understood as two distinct tracks, diverging even further. Headline growth 4.3 to 4.4%, inflation just 0.8 to 1.2%, reflecting persistent demand weakness. Track 1, the strong track, high-tech manufacturing is booming. Green energy exports, EVs, semiconductors, and advanced machinery are driving growth in coastal provinces like Shenzhen, Shanghai, and Suzhou. This is where Beijing's industrial policy focus is delivering tangible results. These export-oriented tech hubs are genuinely thriving. Track 2, the weak track, domestic consumption remains subdued. Household confidence stays low amid ongoing property sector adjustment. Interior provinces dependent on construction and traditional manufacturing are struggling. Youth unemployment remains elevated, and near-zero consumer inflation reflects weak demand, not supply abundance. This map illustrates the geographic reality. The teal and dark green regions along the coast, where high-tech exports cluster, are prosperous. The amber and red interior regions, where traditional industries dominate, are facing significant challenges. Beijing's policy response: continue choosing industrial upgrading over broad consumer stimulus. The central question: how long can this dual-track model persist before social pressure forces broader support for domestic consumption? What could go right, wrong, or sideways in 2026? We see three distinct scenarios with varying probabilities. Scenario 1: soft landing achieved. Probability 45%. What happens? Inflation converges to target without triggering a recession. Central banks successfully normalize policy. The U.S. avoids a hard landing. China stabilizes, and trade tensions plateau. Market implications: equities see high single-digit gains, bonds rally as rates decline, credit spreads tighten, and the dollar weakens gradually. Scenario 2: stagflation light. Probability 35%. What happens? Inflation proves stickier than expected, particularly in services and wages. Central banks are forced to keep policy tighter for longer. Growth disappoints at 2.4 to 2.6%. Market implications: equities flat to down, bonds range-bound and volatile, credit spreads widen, the dollar stays strong, and gold performs well. Scenario 3: trade shock. Probability 20%. What happens? A new escalation in U.S.-China tensions leads to additional tariffs, causing supply chain disruptions and a confidence shock to investment. Growth falls to 2.0 to 2.3%. Market implications: equities down 10 to 15%, safe havens rally, emerging markets experience significant stress, and volatility spikes materially. As this probability bar shows, we lean toward the soft landing outcome, but with meaningful risk that inflation proves more persistent. How should investors position for this environment of stabilization without a strong rebound? For equity investors, sector rotation matters. Start 2026 favoring defensives and quality companies as rate uncertainty lingers. Then, pivot towards cyclicals and small caps by mid-year if the soft landing scenario solidifies. Geographic allocation. Overweight India and select ASEAN countries, maintain moderate U.S. exposure, and underweight Europe despite cheaper valuations. Be highly selective in China. Tech and export beneficiaries, yes, but consumer-facing sectors, no. Themes to play: AI and digital infrastructure, energy transition winners like EVs and batteries, near-shoring beneficiaries such as Mexico and Vietnam, and quality companies with pricing power. For fixed income investors, start extending duration as the Fed pivot becomes clear. Target the 5 to 7 year sweet spot for optimal risk return. Avoid very long duration. Terminal rates will remain higher than the pre-2020 era. Investment-grade credit is attractive, but be selective in high yield. For multi-asset portfolios, diversification is critical. The traditional 60-40 portfolio may disappoint. Consider adding alternatives like private credit and infrastructure. Maintain a 5 to 10% allocation to gold as a geopolitical hedge. Currency views: expect a weaker dollar, a stronger yen, and selective strength in emerging market currencies like the Indian rupee.
Success in 2026 requires knowing what to watch each quarter. Let me walk you through the key inflection points. Q1, the inflation question. Watch U.S. CPI and PCE data from January through March, China's post-New Year credit data, and European wage negotiations. The signpost: if U.S. core PCE sustains below 2.8%, then a June Fed cut becomes highly likely. Q2, the policy pivot. Watch the Fed's first rate cut timing and messaging, plus corporate earnings guidance for the second half of the year. Two signposts here. If corporate guidance remains resilient, the soft landing narrative strengthens. But if the Fed signals, quote, one and done, then markets will be disappointed. Q3, labor markets and elections. Watch the U.S. unemployment trend, China's export data, and U.S. election outcomes. Key signpost: if unemployment rises above 4.5% quickly, then recession risk increases significantly. Q4, setting up 2027. Watch year-end inflation prints and evidence of AI return on investment in corporate CapEx plans. The key signpost: if inflation is truly at 2.0 to 2.3% by December, then 2027 can become a growth-focused year. These quarterly checkpoints will tell us which of our three scenarios is materializing.
So, what does 2026 represent? It's a year of transition, from deceleration to stabilization, from peak policy restriction to gradual easing, and from crisis management to structural adaptation. What changes? Monetary policy shifts from being a headwind to neutral. Inflation pressures ease meaningfully toward target. Financial conditions loosen modestly. And market focus shifts from will we crash to how fast will we grow? What persists? Trade fragmentation and supply chain complexity aren't going away. A trade geopolitical risk premium will remain embedded in all major decisions. China's structural growth model challenges continue, and fiscal constraints limit policy space across the board. What's uncertain? The precise timing and pace of central bank easing, the magnitude of China's domestic demand weakness, the severity of Europe's competitiveness erosion, and the true extent of AI-driven productivity gains. The core message: 2026 is the year the global economy fully adjusts to the new normal, not a return to past glory, but the emergence of a new equilibrium defined by lower growth, higher structural rates, and fragmented trade.
As we close, here are the final takeaways by stakeholder. For investors, 2026 requires patience, selectivity, and diversification. This isn't a year for aggressive bets on either a strong rebound or an apocalyptic collapse. Position portfolios for multiple outcomes, but lean toward gradual improvement. Avoid making concentrated bets in either direction. For businesses, invest in productivity and efficiency. Diversify your supply chains proactively, maintain financial flexibility, and prepare for a permanently higher cost of capital. Cheap money isn't returning anytime soon. For policymakers, 2026 is a test of judgment. The path to normalize policy is narrow. Ease too quickly and risk reigniting inflation. Ease too slowly and inflict unnecessary economic pain. Coordination across central banks matters more than ever. After the turbulence of the 2020s so far, pandemic, inflation surge, monetary shock, and structural shifts, 2026 offers the global economy a chance to find its footing, not a return to past glory, but the emergence of a new equilibrium. Whether that equilibrium proves durable depends on the decisions made throughout this critical transition year.
Thank you for watching. Subscribe for more updates throughout the year ahead. I'll see you soon.